SLB's first quarter 2026 earnings are officially out. We're looking at a mixed bag where they technically beat the top-line consensus with revenue of $8.72 billion, but they missed hard on the bottom line. GAAP earnings per share came in at just 50 cents, which is down 14% year over year.
Yeah, and adjusted EBITDA also fell short, dropping 12% down to $1.77 billion.
Exactly. Full-year capital investment guidance is holding steady at $2.5 billion, but the stock definitely took a hit in early trading following that EPS miss.
It's a really stark set of contradictions to open a quarter with, for sure. You're looking at a top line that suggests expansion, but the actual money flowing to the bottom line is just shrinking by double digits.
Right, and that is exactly the puzzle we are decoding for you today in this deep dive. We're looking past those headline numbers into SLB's Q1 release and their SEC Form 10-Q.
Because if you just glance at that 3% revenue growth, you're missing the entire story of this quarter.
Completely. The filings reveal this massive recent acquisition that's basically masking a core decline. Plus, you have these severe geopolitical disruptions, bleeding cash, and this really aggressive pivot into artificial intelligence.
Let's start with that revenue contradiction. The growth and the plummeting earnings per share hinge almost entirely on one strategic move, which is the acquisition of ChampionX back in the third quarter of 2025.
Right, because this first quarter of 2026 is where we finally see the full weight of that purchase on the books. I mean, ChampionX brought in $838 million in revenue for this quarter alone.
Which means you have to do some quick subtraction to see what's actually happening.
Exactly. If you back out that $838 million from ChampionX, SLB's legacy operations didn't grow at all. I mean, their global organic revenue actually decreased by 7% year over year.
Yeah, and the regional breakdowns paint an even sharper picture of that. Without the ChampionX revenue, padding the numbers, international revenue dropped 7%, and North American revenue fell by 8%.
Wow. So the headline growth is entirely manufactured by the acquisition.
Pretty much.
It's like, it reminds me of an automaker watching its flagship car sales plummet. So management just goes out and buys a highly profitable tire manufacturer to merge the books.
That's a great way to put it.
Right, because suddenly total automotive sales look fantastic on the quarterly report. But the reality is the core engine is stalling. The tire company is carrying the whole load.
Yeah, that's exactly what we're looking at. SLB's traditional extraction business, the car sales in your analogy, is experiencing a real slowdown. But ChampionX is pumping out serious volume in a very high-demand niche.
And that niche is production chemicals and artificial lift, mostly focused on the North American unconventional markets like the Permian Basin.
Right. And artificial lift isn't just about pumping oil out of the ground. It's really the science of maximizing the pressure dynamics of an aging well.
You use tailored chemistry to change the fluid's viscosity, right?
Yeah, exactly. Or you use mechanical systems to physically push the remaining hydrocarbons to the surface. It aligns perfectly with what CEO Olivier Leptouch outlined in the release. Operators right now are highly focused on capital efficiency.
They aren't rushing out to drill massive, risky new exploratory wells.
No, they want to squeeze every last drop out of the infrastructure they've already paid for.
Which makes the ChampionX acquisition look incredibly prescient. It directly drove the production systems segment revenue up 23% to $3.5 billion.
It did, but that still leaves us with the 7% organic decline staring us in the face.
Right. So going back to the automaker metaphor, why are the core car sales dropping so sharply?
Well, the answer in the 10Q is almost entirely geographical and geopolitical. The primary headwind dragging down the organic business is the widespread disruption across the Middle East.
Yeah, the numbers for the Middle East and Asia region are just brutal. Revenue landed at $2.68 billion for the quarter. That is a 17% sequential drop from Q4.
And a 10% drop year over year.
Which is huge when you consider the Middle East alone accounts for 70% of that region's revenue. So this isn't just a seasonal fluctuation.
No, not at all. This is a massive operational halt. Management was very explicit about this in the filings. They were forced to actively demobilize operations across several countries.
Because when regional conflicts escalate, operators take defensive actions. Extraction becomes secondary to safety.
Exactly. You pull your engineers out, you shut down the active rigs, and you halt new well construction entirely.
Which explains the severe margin crush we're seeing. Well, construction revenue dropped 6% year over year, but the pre-tax operating margin plummeted by 463 basis points.
It's a steep drop.
I mean, I would hypothesize that margin hit is purely fixed costs.
Huh.
You can stop a drill bit instantly, but you can't just stop paying hundreds of specialized engineers sitting idle.
That is the exact mechanical reality of demobilization. You have highly expensive, ruggedized machinery and really well-paid technical staff.
And you can't just instantly break the leases on multi-million-dollar equipment.
Right. When a conflict forces a shutdown, your billable revenue drops to zero immediately. But the logistical cost of securing a well and transporting equipment out of a hot zone is astronomical,
You're burning massive amounts of cash just to retreat.
which absolutely obliterates your operating margins for the quarter.
So if you're a retail investor listening to this, the immediate question is this just a temporary geopolitical blip, or is this conflict forcing a permanent structural change in global energy investment?
Well, according to Lapuche's market outlook, we are witnessing a structural shift. The conflict has essentially accelerated a rebalancing of global supply and demand.
Meaning it's laid bare the vulnerabilities in an energy supply chain that's overly reliant on one highly volatile region.
Exactly. The market is pricing in a persistent geopolitical risk premium now.
So even after the immediate tensions subside, commodity prices will likely remain elevated.
That's SLB's projection, yes, because you have physical infrastructure impairments that degraded actual production capacity, combined with buyers who simply don't trust the stability of the supply anymore.
So national and independent oil companies are going to prioritize supply diversification. Where does SLB expect that capital to flow?
They project the investments will diverge into two different timelines: short cycle and long cycle projects.
Okay, break that down for me.
Sure. So first, you'll see a surge in short cycle investments in the Americas, like the U.S. shale patches or Latin American onshore fields. You can deploy a rig and start extracting cash-flowing oil in a matter of months.
A rapid supply response and the long cycle side.
And that capital will flow into deep-water offshore markets. These require billions in upfront capital and take years to yield the first barrel of oil.
But they offer massive stable reserves away from the geopolitical land wars.
Exactly. And SLB is betting this dual-pronged response sets up a broad-based recovery in the upstream markets for 2027 and 2028.
But if traditional rig deployments are permanently complicated by this risk, SLB has to find a way to monetize something that doesn't require a physical drill bit.
Right. Which brings us to the most surprising part of this 10Q.
Yes, the digital segment breakdown. Suddenly, SLB stops sounding like a century-old industrial giant and starts sounding like a Silicon Valley hyperscaler.
It's arguably the most important long-term narrative in this report. The digital segment grew 9% year over year to $640 million.
But the metric that fundamentally changes the valuation here is their ARR, their annualized recurring revenue. They reported that their digital ARR exceeded $1 billion again.
The 15% increase year over year.
$1 billion in recurring software revenue sitting inside an oil field services company. That is wild.
Because recurring revenue changes the entire valuation multiple of a business. It provides predictable, high-margin cash flow that isn't dependent on daily commodity market fluctuations.
And they are expanding that footprint rapidly. Their data center solutions business experienced a 45% year-over-year revenue uplift, hitting $141 million.
Plus, they announced an expanded collaboration with NVIDIA to build an AI factory for energy.
Right, and if you take a step back, you really have to ask, why does an oil extraction company need an AI factory, modular data centers, and what they're calling industrial-scale agentic AI?
It seems like a massive leap from pumping chemicals into a well.
It does.
But it's necessary to unlock the value of the assets they already own. For decades, SLB has been quietly accumulating petabytes of the most complex geological and seismic data on Earth.
And historically, human engineers would manually analyze those charts for weeks to pinpoint a drilling location.
Exactly. Now they're taking all that proprietary historical data and using NVIDIA's compute power to train AI models that automate the extraction science.
So they are essentially becoming the AWS of the energy sector.
That's the core of the strategy, but the specific focus on agentic AI is crucial.
Yeah, clarify that for me, because we're all used to generative AI, like a chatbot.
Right. Agentic AI is different. It involves autonomous systems that can actually take actions within a workflow.
Oh,
Yeah, so in an oil field context, an agentic AI system could monitor real-time seismic feedback from a drill bit, calculate changing rock density, and autonomously adjust the drilling angle.
without waiting for a human engineer to approve the math.
Exactly. The efficiency gains are staggering, replacing weeks of manual calculation with instantaneous, optimized decisions.
Which explains why operators are so eager to subscribe to these digital tools. driving that 15% ARR growth.
And SLB is pushing even further into the physical infrastructure to run those models.
The modular data centers.
Right. They're taking their century of expertise in building ruggedized equipment for harsh environments, like offshore platforms, and adapting that to build scalable, off-site modular data centers.
Because the tech industry desperately needs physical infrastructure that can survive extreme conditions. And SLB already knows how to build it.
Precisely. They're also aggressively buying their way into the software ecosystem. The 10Q details a definitive agreement to acquire S&P Global Energy's subsurface software business.
And that acquisition is just a masterclass in interoperability. S&P's software is already deeply entrenched in the daily workflows of U.S. onshore operators.
They aren't just buying code. They're buying direct access to the computer screen those engineers look at every single day.
The filing notes, they plan to integrate this tech stack with their own Lumi platform and their Tele AI framework.
But they're being very careful. They want a deliberate approach that preserves existing customer workflows.
Right, because end users hate when a new corporate owner forces them to learn a new interface.
Exactly. SLB's strategy is to leave the dashboard exactly the way the customer likes it, but quietly replace the engine underneath with their Tele AI framework.
The operator clicks the same buttons, but the underlying computations are drastically faster. It's a brilliant way to achieve massive scale without triggering customer churn.
But, when you look at the overall financial health of this company, you have to reconcile these contrasting realities.
You really do. You have a struggling traditional core masked by Champion X, brutal margin compression in the Middle East, and this booming AI business.
And all of that filters down into the cash flow statement. If you're reading the balance sheet for the first time, your instinct might actually be to panic.
Yeah, the free cash flow metric is definitely the most jarring number in the report. Cash flow from operations was $487 million, but after capital expenditures, free cash flow is negative $23 million.
They bled cash this quarter.
Right. But if you look at the shareholder returns section, management acted like they were swimming in excess liquidity.
They really did.
I mean, let's unpack this. They spent $451 million buying back 9.2 million shares of their own stock. And the board just approved a 3.5% increase to the quarterly cash dividend,
Pushing it to roughly 29 cents per share.
So how do you justify handing out $500 million to shareholders when you are actively running a negative free cash flow for the quarter?
Well, you justify it when you have a fortress balance sheet, and you need to aggressively signal long-term conviction to the market.
Ah, okay.
Look at their actual liquidity position. As of March 31st, SLB was sitting on $3.4 billion in cash and short-term investments, supplemented by $5 billion in available debt facilities.
Okay, so they are not living paycheck to paycheck on their quarterly free cash flow. They have a massive savings account to cover investments and returns simultaneously.
Precisely. Management committed to returning more than $4 billion to shareholders in 2026. Doing that even with negative Q1 cash flow is a highly calculated message.
They're telling institutional investors that the Middle East demobilization costs are just a temporary, isolated burn.
And they're telling the market that the stock is currently undervalued, which is why they executed those buybacks at an average price of $49.04.
It's a massive flex of the balance sheet.
Yeah.
They're absorbing the geopolitical blow, maintaining their capital investment guidance, and raising the dividend.
They are betting heavily that the software integration, the AI factories, and the Champion X synergies will intersect perfectly with that projected 2027 market recovery.
It's a high-stakes, highly orchestrated bet on the structural future of the industry. They're refusing to cut back on exploration data investments just to make one quarter's cash flow look prettier.
Which leaves you with a really profound question about the identity of the company itself.
Right. I mean, for 100 years, the ticker SLB represented the quintessential physical oil field services company. Hard hats, mud, steel pipes.
But today, they're generating over $1 billion in recurring software subscriptions.
They are manufacturing modular data centers and deploying autonomous agentic AI.
The separation between the physical extraction of natural resources and the digital infrastructure required to model them is completely vanishing.
Whoever dominates the data and processing power ultimately controls the efficiency of the physical extraction.
Exactly. It completely reframes how you look at the energy sector.
Are we no longer just talking about oil and gas providers? Are we actually witnessing the transition of traditional industrial heavyweights into deep tech infrastructure companies?
I think we are. The energy company of the 2030s will likely look much more like a tech hyperscaler than a traditional wildcatter.
That is a fundamental shift in valuation, and it is definitely something for you to mull over before the next quarter's numbers drop.
It's the real signal cutting through the noise of this 10Q.
Absolutely. Thank you for joining us on this deep dive as we unpacked the true mechanics behind SLB's first quarter numbers. Make sure to follow the show for our daily earnings coverage, and we will catch you on the next one.